On February 5th, the silver market did something that should have triggered immediate alarm. After a brutal sell-off erased weeks of gains and forced traders out at the worst possible moment, silver didn't behave like a market finding stability. It didn't drift lower. It snapped back violently. Prices surged fast enough to shock traders, confuse analysts, and flood headlines with the wrong question: is the worst over? Almost no one stopped to ask the more important one: why did the market need this level of violence in the first place? If this kind of breakdown matters to you, hit like and subscribe, because what you're about to see doesn't get explained honestly anywhere else. What most people saw was a rebound. What actually happened was a stress response. Moves like this don't show up in calm, healthy markets. They appear when pressure breaks, when leverage collapses, and when positions are forced out, not closed by choice. In moments like that, price becomes a distraction. The real story is underneath, in who was liquidated, who stayed liquid, and who quietly absorbed the damage while everyone else was scrambling. The crash leading into this rebound wasn't emotional. It was mechanical. Margin pressure increased. Liquidity thinned. Stops were triggered automatically. Traders weren't making decisions. They were being removed. In markets like this, conviction doesn't matter. Belief doesn't matter. Only balance sheets do. Smaller participants are forced to act immediately. Larger institutions don't. That imbalance isn't accidental. It's structural. As price rebounded, attention stayed locked on charts. But beneath the surface, stress didn't disappear. It shifted. Volatility didn't fade. It relocated. And right as fear peaked, reports began surfacing about massive institutional exposure tied to silver derivatives. That's where the real story starts, because this move wasn't random, and it wasn't resolution. To understand why this matters far beyond silver prices, you first need to understand who pays when markets reset like this and who doesn't. What happened in silver wasn't just a market event, it was a wealth event. Because moves like this don't stay trapped inside charts. They spread outward, into savings accounts, retirement plans, pensions, and long-term financial security. When a market can erase double-digit value in days and then rebound violently without warning, it exposes something far more serious than volatility. It exposes fragility. If you're holding cash, planning for retirement, or trying to protect purchasing power in an inflationary world, this matters to you whether you trade silver or not. Silver is not just another commodity. It's a pressure gauge. It sits at the intersection of money, industry, and leverage. It's used in energy, technology, manufacturing, but it's also heavily traded on paper through futures and derivatives. That combination makes silver extremely sensitive to stress inside the financial system. When liquidity tightens or leverage breaks, silver often reacts early and violently. That violence has consequences. When markets reset this way, losses don't land evenly. Institutions with deep balance sheets can absorb swings, hedge exposure, and wait. Households can't. Forced selling doesn't just wipe out positions, it locks in damage. And once losses are locked in, recovery becomes exponentially harder. This is where history matters. In previous cycles, sharp silver corrections didn't happen in isolation. They appeared alongside broader financial stress, credit tightening, currency pressure, and rising systemic risk. Silver didn't cause those problems. It reflected them. It moved last on the way up and first on the way down. That pattern is dangerous because it's easy to misread. People assume silver is just volatile, but volatility is a symptom, not the disease. The real issue is leverage. When leverage builds across the system, stability becomes an illusion, confidence replaces resilience, and when pressure finally arrives, it doesn't ask permission. Margin requirements rise, liquidity disappears, smaller participants are forced to act quickly, often at the worst possible time. Larger players don't face that urgency. That imbalance isn't accidental, it's structural. Retail participants are exposed to volatility. Institutions are positioned around it. When conditions tighten, one side is forced to sell while the other waits. That's how risk quietly transfers during stress, from those who must react to those who can afford not to. This is why these events always feel one-sided. It's not about who guessed the market correctly. It's about who had flexibility and who didn't. When silver crashed and rebounded, it revealed more than bad timing. It showed how quickly power shifts when markets fracture. Who absorbs losses, who survives disorder, and who emerges positioned for what comes next. That's why this isn't just about price, it's about control. And once you understand that, the uncomfortable question becomes unavoidable. If these patterns repeat, leverage builds, pressure hits, weak hands exit, strong hands endure, then these events aren't random accidents. They're predictable outcomes of how the system is designed. And in the next chapter, we're going to focus on the institution that sits closest to that design, and why its role matters far more than most people realize. To understand what really happened in silver, you have to focus on one institution that repeatedly appears whenever this market enters extreme stress: JPMorgan. Not because of online rumors, not because of conspiracy talk, but because of history, scale, and exposure. JPMorgan is not a casual participant in silver. It is one of the most deeply embedded institutions in precious metals derivatives, across futures, options, and complex structured positions. That level of involvement doesn't mean the bank controls prices. It means the bank sits at the center of how risk moves through the system when volatility explodes, and that distinction is critical. Large institutions do not experience silver the way individuals do. They are not trading headlines, they are not reacting emotionally to price swings. Their objective isn't to guess direction, it's to manage exposure across cycles and survive periods of disorder. That's why reports of massive unrealized losses tied to silver derivatives matter. Not because losses imply failure, but because they signal scale. When stress is large enough to surface inside the balance sheet of a global bank, it tells you pressure has reached deep into the system. Calm markets don't produce those signals. Extreme ones do. But here's where most people misunderstand what they're seeing. An unrealized loss does not mean panic. It does not mean the institution is trapped. Large banks have tools that don't exist for anyone else. They hedge across books. They offset risk through other assets. They restructure exposure. And most importantly, they are not subject to the same margin pressure that forces smaller players out. That is the imbalance hiding in plain sight. When volatility spikes, retail traders and smaller funds are forced to react immediately. Positions are liquidated. Risk is cut under pressure. Losses are locked in. Institutions don't operate under those constraints. They can sit through chaos while the market clears weaker hands for them. This is why JPMorgan's role in silver has drawn scrutiny for years. Not because wrongdoing is always proven, but because concentration of risk at that scale naturally amplifies stress. When too much exposure flows through too few balance sheets, volatility doesn't stay contained. And volatility is where incentives diverge. A violent crash hurts confidence. It forces selling. It resets positioning. For some, that's catastrophic. For others, it's necessary. Institutions with staying power don't need calm markets. They need resolution. They need leverage to break so pricing can function again. This doesn't require coordination. It doesn't require intent. It's mechanical. Markets built on leverage always end the same way. When conditions tighten, the weakest positions break first. Control shifts quietly to those who can endure the disorder. That's why JPMorgan's reported silver stress matters far beyond a headline. It's not about blame. It's about structure. It's a signal that the system was pushed far enough to expose pressure at the top while liquidating risk at the bottom. And when that happens, it tells you this move wasn't temporary. It was structural. But to really understand why this pattern keeps repeating, we need to step back because this exact sequence has played out before, again and again across decades. And when you see those moments side by side, the present stops looking random. What's happening in silver right now feels extreme because it's unfolding fast. But structurally, it's not new at all. In fact, this exact sequence has appeared again and again whenever silver reaches moments of real stress. To understand the present, you have to recognize the pattern. Let's step back. In past cycles, silver never failed quietly. It broke violently. Sharp advances were followed by brutal collapses that convinced most participants the story was over. Confidence evaporated. Headlines turned negative. Late buyers were wiped out. And just when belief was weakest, the market reset and moved again in ways very few expected. The late 1970s silver boom is a clear example. After an explosive rise, silver collapsed hard. Prices were nearly cut in half. Commentators declared the market finished. Leverage was destroyed. Traders were forced out. But once that forced selling ended, silver didn't stabilize slowly. It surged, repricing far beyond what most believed possible. The same structure appeared decades later during the global financial crisis. Silver was crushed alongside nearly every other asset. Liquidity vanished. Futures collapsed. Paper markets seized up. Yet while price action screamed failure, physical demand told a different story. Once panic selling was exhausted, silver recovered aggressively and went on to reach historic highs. These weren't coincidences. They followed a repeatable sequence. First, leverage builds quietly during rising prices. Confidence replaces caution. Risk expands beneath the surface. Then conditions shift. Liquidity tightens. Margin requirements rise. Volatility accelerates. Participants who relied on borrowed exposure are forced to exit. That's when the break happens. Prices fall not because fundamentals disappear, but because positions must be liquidated. Selling becomes mechanical. The market overshoots, and once enough leverage is removed, pressure stops building downward and begins shifting upward. This is the part most people miss. The most violent moves often don't mark the end of a trend. They mark the reset that allows the next phase to begin, but only after control changes hands. What makes the current situation more dangerous is scale. Today's silver market is far more financialized than in past decades. Paper contracts dwarf physical supply. Derivatives amplify exposure. Global demand spans industries, currencies, and supply chains. When stress hits, the system doesn't absorb it smoothly. It fractures, and fractures expose weaknesses that stay hidden during calm periods. Another recurring pattern appears during times of institutional distrust. When confidence in paper promises erodes, silver becomes a battleground between screen prices and physical reality. Paper can reprice instantly, physical metal cannot. When those two drift apart, pressure builds until one side is forced to adjust. We're seeing similar signals now: sharp sell-offs followed by fast rebounds, persistent volatility, continued signs of physical tightness. These are not features of a healed market. They are signs of a system trying to rebalance under strain. History doesn't repeat perfectly, but it rhymes clearly. And the rhyme here is familiar. When silver collapses violently without a collapse in real-world demand, it usually isn't breaking down. It's being reorganized. That reorganization is painful. It transfers risk. It punishes those forced to act and rewards those who can wait. And it almost always happens faster than most participants can process. Which is why the most important information isn't in the headlines. It's in the data underneath them. And that's exactly where we need to look next. If this move in silver were just noise, the data would confirm it. Volatility would fade. Pressure would ease. The market would quietly move on. That's not what the numbers are showing. In fact, when you look beneath the surface, the data directly contradicts the idea that this was a simple crash followed by a harmless rebound. Start with futures positioning. During the sell-off, a large amount of open interest vanished from the silver market. That doesn't happen when long-term holders lose conviction. It happens when leveraged positions are forced out. Rising margin pressure and thinning liquidity don't give traders time to reconsider. They remove them mechanically. The collapse in open interest tells you this wasn't a change in belief. It was liquidation. That distinction matters. When prices fall, while open interest collapses, the selling isn't voluntary. It's structural. Positions are closed because they must be closed. That's the first clear signal that a reset, not a trend failure, is underway. Now compare that to physical silver. If demand were truly breaking down, physical availability would improve, premiums would fall, delivery times would shorten. Instead, physical markets have remained tight. In many regions, premiums stayed elevated and availability didn't suddenly improve. That divergence between paper pricing and physical behavior is not random. Paper markets can reprice instantly. Physical markets can't. When futures collapse but real-world demand holds firm, it creates a disconnect that cannot persist indefinitely. One side must adjust. Either physical demand collapses or paper prices are forced to reconcile with reality. History shows which outcome is more common. Inventory behavior reinforces this. In genuine bear markets, silver inventories rise. Metal flows back into the system. Supply loosens. But during this move, inventories did not expand in a way that matches panic narratives. Instead, they remain tight enough to keep stress visible. That's not weakness, it's imbalance. Then there's backwardation. In calm conditions, silver trades in contango. Future delivery costs more than immediate delivery. Backwardation appears when immediate demand matters more than carrying costs. That doesn't show up in markets that are dying from lack of interest. It shows up when availability is relevant. Backwardation during extreme volatility is a warning sign. It tells you the problem isn't silver itself. It's the structure wrapped around it. International signals add another layer. Outside Western paper markets, silver hasn't behaved like an unwanted asset. Industrial demand remains intact. Regional premiums persist. Usage tied to energy and technology hasn't reversed overnight. Those forces don't disappear because futures traders were liquidated. Now bring institutional exposure back into the picture. When stress appears simultaneously as retail liquidations at the bottom and unrealized pressure at the top, it reveals how risk is transferred. Losses surface where exposure is largest. Liquidations happen where flexibility is smallest. Put it all together, a collapse in open interest, persistent physical tightness, inventory signals that don't confirm panic, backwardation flashing stress, institutional pressure appearing at the same time retail positions are flushed. Each signal alone raises questions. Together, they form a pattern. This wasn't a failure of silver demand. It was a failure of leverage. And leverage failures don't end cycles. They reset them. Which brings us to the most important question of all. What happens next, now that the market is thinner, sharper, and far less forgiving? This is the point where most people get it wrong. After a violent reset, the natural instinct is to expect calm. Sideways price action, stability returning. But silver has never behaved that way after liquidation events. In fact, history shows the opposite. Once leverage is flushed and participation thins out, markets often become more dangerous, not less. That's the phase silver is entering now. With a large portion of speculative exposure already removed, price becomes far more sensitive. It takes less buying to push the market higher and less selling to knock it down. That's why post-liquidation environments produce sharp, sudden moves that feel disconnected from headlines. They're not emotional, they're mechanical. From here, there are two realistic paths. Scenario 1 is the calm everyone hopes for. Physical supply loosens just enough to relieve pressure. Volatility compresses. Price consolidates while confidence slowly rebuilds. This outcome feels safe because it's orderly, but it requires balance, steady liquidity, stable currencies, and no new stress elsewhere in the system. If any of those fail, this path collapses quickly. Scenario 2 is more disruptive and historically more common. In this path, physical demand continues to outpace available supply, even slightly. Inventories don't need to disappear, they only need to tighten at the wrong moment. When that happens, price doesn't grind higher, it reacts. Small imbalances trigger outsized moves because the market is no longer cushioned by excess leverage. This is where silver becomes unpredictable. Triggers matter more than trends at this stage. Currency pressure, changes in margin requirements, stress in credit markets, any one of these can act as a spark. And because positioning is thinner, reactions can be fast and uneven. Geography adds another layer of risk. Paper markets may react first, but physical demand elsewhere doesn't wait. When global supply chains tighten, pricing doesn't adjust smoothly across regions. Premiums appear in one place, while screens elsewhere lag behind. That mismatch builds pressure until repricing becomes unavoidable. Here's what this phase is not. It's not a return to normal, it's not low risk, and it's not confirmation that the system has healed, it's a transition. After liquidation, markets don't become safer, they become sharper, smaller trades carry more impact, sentiment lags behind reality, and confidence becomes dangerous because it encourages people to assume the worst has passed. That's the real risk now. Not guessing where silver goes next, but assuming what you just saw was the final act. Markets that require violence to rebalance rarely resolve quietly. They either stabilize convincingly or move again in a way that forces repricing. Right now, the evidence points to sensitivity, not stability. Volatility hasn't disappeared, it's reorganized. Pressure hasn't vanished, it's shifted. And when pressure shifts instead of fading, it tells you one thing clearly. This phase isn't over, it's setting up the next move.